Here's a number that should concern every investor watching right now: 150%. That's how much silver has climbed in the past 12 months, from $37 an ounce to $93. A move so violent, so compressed, that veteran traders are reaching for history books and finding uncomfortable parallels. On the 14th of January 2026, silver punched through $90 for the first time in modern history. 5 days later, it's flirting with $94. The round number everyone is watching sits just above $100 per ounce. This is how financial accidents begin. Picture the trading floor at CME Group's COMEX division on the 14th of January 2026, 9:47 a.m. Eastern. Screens flash green. Silver futures are moving faster than the algorithms can price them. The Reuters headline drops at 10:02 a.m. Spot silver breaks through $90 per ounce for first time. That breach wasn't random. It was the culmination of months of building pressure, geopolitical risk, Federal Reserve policy expectations, and something more troubling, a fundamental mismatch between paper contracts and physical metal. I'll be straight with you. The silver market operates on a fractional reserve system that would make bankers nervous. For every ounce of registered silver sitting in COMEX vaults, there are multiple claims against it, multiple owners expecting delivery, multiple bets that can't all be settled. At $93 per ounce, this tension remains manageable. At $100, the mathematics change. At $120 or $150, we enter territory that breaks things. The question isn't whether silver hits $100. Based on momentum, sentiment, and structural supply deficits, that seems probable within weeks. The question is what happens when it does. What happens when the paper claims get called in? What happens when industrial buyers, solar manufacturers, electronics companies, EV battery producers compete with speculators for the same shrinking inventory? To understand what's unfolding, you need to see the architecture beneath the price. Silver trades in two parallel universes. There's the physical market, actual metal, actual delivery, actual scarcity. Then there's the paper market, futures contracts, options, ETF shares representing claims on metal that may or may not exist in deliverable form. The iShares Silver Trust, ticker SLV, has absorbed billions in inflows during 2026. Each dollar in requires the trust to purchase and store physical silver. That's metal removed from the tradable supply, tightening an already constrained market. According to COMEX warehouse data from January 2026, registered silver stocks, the metal actually available for delivery against futures contracts, sit well below historical norms. The cushion that allows futures markets to function smoothly is eroding. Here's the thing. Markets can operate with thin inventory when prices are stable. When prices spike 25% in 3 weeks, when every speculator, every industrial hedger, every ETF manager is scrambling for the same metal, that's when thin inventory becomes a delivery crisis. That's when paper claims collide with physical reality. And that collision is approaching faster than most participants realize. Let me map the forces pushing silver toward that $100 threshold. Driver 1 is rate expectations. Soft inflation data released in early January 2026 triggered immediate repricing of Federal Reserve policy expectations. Lower rates mean lower opportunity cost for holding precious metals. Money rotates from bonds into gold and silver. This isn't speculation, it's institutional allocation following a mathematical signal. Driver 2 is geopolitical risk. The Trump administration's renewed tensions over Greenland have injected uncertainty into global markets. When political risk rises, capital flows into hard assets. Gold hit record highs on the 19th of January 2026. Silver followed, with Reuters reporting the rally was sparked by tariff-driven geopolitical uncertainty. Driver 3 is structural industrial demand. This is the sleeper factor most analysts underweight. Solar panel production requires silver for conductive paste. Electric vehicle manufacturing consumes silver for batteries and electronics. Global green energy build-out is accelerating, and every megawatt of solar capacity, every EV rolling off assembly lines, removes silver from available supply. Think about it. Investment demand competes with industrial demand. Both are rising simultaneously. Supply from mining operations remains relatively flat. The math doesn't balance. Driver 4 is thin inventory. COMEX registered stocks have declined, while open interest in futures contracts has expanded. More claims, chasing less metal. A recipe for delivery stress when prices move violently enough to trigger contract settlement. 4 forces, one direction, converging on a single price level. Now here's where the investigation gets uncomfortable. The silver futures market functions on an assumption. Most contracts settle in cash, not metal. Traders roll positions forward. Speculators close before delivery dates. The actual exchange of physical silver remains a small fraction of notional volume. This works beautifully in calm markets. Prices discover, hedgers hedge, speculators speculate. Everyone goes home happy. But what happens when that assumption breaks? What happens when enough market participants decide they want actual metal instead of paper claims? When industrial users worried about supply disruption demand delivery? When investors spooked by counterparty risk want silver in their hands? The answer is written in history. January 1980, Silver Thursday. Nelson Bunker Hunt and his brother William Herbert Hunt accumulated massive silver positions, both futures contracts and physical metal. They controlled an estimated 1/3 of the entire world's deliverable supply. When they attempted to take delivery on their futures positions, the system seized. COMEX changed the rules mid-game. New position limits. Liquidation-only trading. The Hunt brothers were forced to sell. Silver crashed from nearly $50 to under $11 within 2 months. The parallels to today aren't perfect, but the structural dynamic, paper claims exceeding physical supply, rhymes uncomfortably. At current prices, that dynamic remains manageable. At $100, with momentum accelerating and delivery demand rising, the system faces its first real stress test in decades. Let me show you the mathematics that keep risk managers awake. Consider a hypothetical hedge fund with a concentrated short position in silver futures. They sold contracts at $75, expecting prices to decline. Standard commodity trading. At $93 per ounce, they're underwater by $18 per contract. For every 1,000 contracts controlling 5 million ounces, that's a mark-to-market loss of $90 million. At $100, the loss expands to $125 million on the same position. At $120, it's $225 million. At $150, it's $375 million. Now consider leverage. Futures trading typically operates at 10-to-1 to 30-to-1 leverage. A fund with $50 million in capital controlling $500 million in positions needs silver to stay within a narrow band. A 10% adverse move can trigger margin calls. A 20% move can force liquidation. Silver moved 8% in a single session on the 15th of January 2026. That kind of volatility destroys leveraged positions. CME Group responds to volatility with margin increases. Higher margins mean more capital required to hold positions. Funds that can't meet margin calls must liquidate. Forced liquidation accelerates price moves. Accelerating prices trigger more margin calls. Check this out. This is the reflexive spiral that transforms orderly markets into disorderly ones. The specific funds holding concentrated silver positions aren't publicly disclosed, but the structural vulnerability is mathematical fact. Behind the price action, a quieter crisis is building. COMEX warehouse reports show registered silver, the metal actually available for delivery against futures contracts, at levels that wouldn't have seemed alarming 5 years ago. But context matters. 5 years ago, silver traded at $25. Investment demand was muted. Industrial consumption was lower. The inventory-to-demand ratio allowed comfortable delivery settlement. Today, silver sits at $93. Investment demand has exploded. 25% gains in 3 weeks attract capital. Industrial demand continues climbing with green energy expansion. The same inventory now must satisfy dramatically higher draw requirements. The Economic Times reported on January 16, 2026, that silver retreats by 8% from highs after nearing $94. Profit booking or pause before $100? That pullback from $94 to approximately $86 demonstrates the volatile equilibrium. But here's what the headline misses. The pullback didn't ease delivery pressure. It just delayed it. The structural supply deficit remains. The inventory constraints persist. The next leg higher, and momentum strongly suggests one is coming, will test those constraints more severely. Physical premiums tell the story clearly. When physical silver trades at a significant premium to spot prices, it signals delivery stress. It means buyers willing to pay extra for actual metal rather than paper claims. Those premiums have been expanding, not dramatically yet, but the trend is directional, and direction, in markets, often accelerates. Stay with me here. The history matters. 1980's Silver Thursday wasn't the only time leverage and limited supply created market dislocations. In September 1998, Long-Term Capital Management, a hedge fund staffed by Nobel laureates and trading legends, faced liquidation after its leveraged positions moved against it. LTCM's trades seemed uncorrelated, genius-level diversification, but when stress hit, correlations spiked. Everything moved against them simultaneously. A fund with $4.7 billion in capital controlling $125 billion in positions, leverage exceeding 25 to 1, found itself unable to exit. The Federal Reserve organized a private bailout, not because LTCM's investors deserved saving, but because LTCM's counterparties included every major bank on Wall Street. Letting LTCM fail meant letting those counterparty exposures cascade. The silver market in January 2026 doesn't have an LTCM-sized player visible to public markets, but the derivative exposure, futures, options, ETF structures, creates similar counterparty webs. When prices move violently, counterparty stress materializes, market makers widen spreads, liquidity evaporates, the orderly price discovery mechanism breaks down. I'm not making this up. This is documented behavior in commodity markets during extreme moves. The 2020 oil price collapse, when futures briefly traded negative, demonstrated how quickly assumptions about market function can shatter. Silver at $100 may not shatter anything, but silver at $150, with delivery demands exceeding available inventory, creates conditions where shattering becomes possible. The warning signs are present. Whether they're heeded is another question. Let me put it this way. What you're watching unfold has a name. It's called a squeeze. A squeeze occurs when short sellers, those who've bet on prices declining, are forced to cover their positions by buying. Their buying accelerates the price increase. Higher prices force more short covering. More covering pushes prices higher still. The classic squeeze combines two elements: significant short interest and limited supply of the underlying asset. Silver currently exhibits both. Short interest in silver futures remains elevated, not at historical extremes, but substantial. These are traders who sold contracts expecting prices to fall. At $93 per ounce, they're wrong. And being wrong in futures markets costs money daily. Supply constraints complete the squeeze setup. If short sellers decide to exit, either voluntarily or through forced liquidation, they must buy to close their positions. But buying requires someone willing to sell. With inventory tight and industrial demand persistent, willing sellers become scarce at certain price levels. The result: gaps. Price jumps between trades as buy orders chase retreating asks. The orderly market becomes disorderly. The controlled burn becomes a wildfire. Seeking Alpha published analysis 3 days ago titled Silver with a History of Crashing. Investors should consider the 80/50 rule. The piece acknowledges silver's crash history while recognizing current momentum. That tension between momentum and crash risk defines the current moment. Based on current trajectory, here's how the next several months likely unfold. Phase 1 covers now through late January. Silver consolidates around $90, $95. Volatility remains elevated. Each dip attracts buyers. Each spike triggers profit-taking. The market builds energy for the next directional move. Phase 2 covers February 2026. If macro conditions remain supportive, continued rate cut expectations, persistent geopolitical risk, silver tests $100. The psychological barrier triggers intense media coverage. Retail interest spikes. Fresh capital flows in. Phase 3 covers March through April. A sustained break above $100 activates the squeeze dynamic. Short covering accelerates. Delivery stress becomes visible in physical premiums and inventory drawdowns. CME Group likely responds with margin increases, attempting to cool speculation. Phase 4 covers May through June, either exhaustion or crisis. If buying pressure subsides, prices correct, potentially sharply, mirroring the 8% pullback we witnessed on January 15 but more severe. If buying continues and delivery demands exceed inventory, we enter uncharted territory. Market function degrades. Emergency measures become possible. Phase 5 covers the second half of 2026. Market rebalances at a new equilibrium. Either prices establish a higher floor with inventory normalized, or a crash resets valuations to levels that restore supply-demand balance. The precise path depends on variables impossible to predict: Federal Reserve decisions, geopolitical developments, industrial demand trends, speculator behavior. But the structural pressures are visible now, in real-time data. CME Group controls the most powerful lever in this market: margin requirements. Margin is the cash deposit required to hold futures positions. When volatility rises, CME raises margins. Higher margins mean traders need more capital. Those who can't provide it must reduce positions. In 1980, COMEX raised silver margins repeatedly as prices spiked. The cumulative effect forced liquidation of leveraged positions, contributing to the crash. History suggests similar intervention becomes likely if silver approaches $120, $150. Each margin hike creates a pressure release, forced selling that temporarily caps prices. But each intervention also signals to the market that authorities are concerned. That signal can itself become self-fulfilling. The timing and magnitude of margin changes isn't predictable, but recognizing that this tool exists and will be used helps frame expectations. A sharp margin increase at $100 could trigger the correction bears expect. Alternatively, if margin hikes are too gradual, they may fail to contain momentum, allowing prices to overshoot before the inevitable correction. For individual investors watching this unfold, the margin dynamic creates discontinuous risk. Prices don't always move smoothly. Regulatory intervention can create gaps. Being positioned for steady appreciation, only to face a sudden 15% drop on margin news, is a real hazard. Given these dynamics, how should observers position? For those already long silver, consider reducing leverage. Options provide defined risk exposure without margin call vulnerability. Protective puts establish floors beneath positions. The cost of insurance, option premiums, may seem expensive in a rising market. The alternative, unlimited downside in a flash crash, is worse. For those considering entry, patience is key. The market has already moved 25% in 2026. Chasing momentum at $93 after missing the move from $75 is emotionally satisfying but mathematically risky. If corrections offer opportunities, they'll come quickly and may not last. Set target prices rather than market orders. For industrial users, hedge. Lock in prices for 2026 requirements now. The cost of being wrong on timing, paying slightly above spot for forward delivery, is manageable. The cost of being unhedged if prices spike to $150, potentially business-threatening margins, is not. For long-term allocators, physical ownership and allocated storage provides ultimate counterparty protection. You're not exposed to futures margin calls, ETF redemption gates, or exchange rule changes. The metal is yours. Diversification across precious metals makes sense. Gold often moves with silver, but typically with lower volatility. A barbell approach, some silver for upside participation, some gold for stability, balances risk profiles. The worst position, concentrated, leveraged, directional bets without hedges. That's not investing. That's gambling with borrowed chips. I'm telling you this because the information asymmetry matters. Institutional traders see these dynamics clearly. They have real-time access to inventory data, positioning reports, and internal risk models. They're adjusting portfolios accordingly, reducing leverage, hedging exposures, preparing for volatility. Retail investors, in my experience, often arrive late. They see headlines about silver hitting record highs. They fear missing out. They buy at peaks. They hold through crashes. They sell at bottoms. That pattern is preventable with information. Understanding why silver is moving, what structural forces are at play, what triggers could reverse the trend, this knowledge is protective. Investopedia reported 2 days ago. Silver prices are up 25% already in 2026. Can they keep rising? The honest answer, maybe. The complete answer, yes. Potentially much higher, but with crash risk that escalates at each threshold. The mathematics are clear. The timeline is compressed. The window for preparation is narrowing. In 1980, they said silver couldn't hit $50. It did. Then it crashed 78%. In 2008, they said the financial system couldn't break. It did. Then it was rescued with printed money. In 2011, they said silver couldn't revisit $50 again. It did. Then it collapsed back to $14. Now it's 2026. Silver sits at $93, approaching the next psychological barrier. The structural conditions, tight inventory, rising demand, leveraged positioning, create an environment where sharp moves in either direction remain possible. The question isn't whether to pay attention. The question is whether the attention translates to action. Monitor COMEX registered inventory. Watch physical premiums versus spot. Track CME margin announcements. These are the early warning systems. When inventory drops sharply, when premiums spike, when margins rise, those are signals. Acting on signals before they become headlines is the difference between preparation and reaction. The silver market is telling a story. The numbers don't lie. The mathematics are certain. The rest, as always, is up to you.